Today's title of MCF's Perspective Moment is Managing Market Volatility. First, let me share that MCF is continuing our thoughts and prayers for those of you that may be suffering from health or financial related issues caused by this COVID-19 pandemic. Several weeks ago, March 23rd, I shared with you uncertain times. Markets don't like fear and uncertainty. To date, 2020 has certainly been a challenging year for investors. After an 11-year U.S. stock bull market, things quickly changed. On March 23rd, the U.S. stock market was down 34% from its February 19th high, the fastest ever decline in our history. And then immediately after my comments on March 23rd, which were, we are likely at or near a bottom, the market turned up and had its fastest increase in history by gaining 27% in 2 weeks. Well, that's the first time in my career I've been lucky. No one can predict this kind of volatility. MCF certainly cannot predict the future, but we can help create it. Think back 20 or 30 years ago and consider what's happened since. The destabilizing events in the world, in our country, in our life, beyond all expectations. None of us can predict with certainty the twists and turns our lives will take. Life is uncertain. The future is unknown. And this isn't neither good or bad. It just is. Yet the tasks remain. How to master our own fate. Well, how come some investors survive and perhaps even benefit in volatility and others don't? What distinguishes those who perform exceptionally well from those that underperform, or worse yet, fail? Many people would say, just stay the course. And most think that means batten down the hatches and hold on. However, when we at MCF say stay the course, we mean staying the course to continue following your diversified investment strategy. We do this by rebalancing your portfolio when the asset class weightings move outside of their policy targeted percentages. This takes discipline and focus. At MCF, we have a 2% tolerance band for each asset class, at which time when the market volatility moves beyond the 2% parameter, we sell those asset classes that exceed their threshold and buy the ones that are underweighted. In effect, forcing us to buy low and sell high, staying focused on your long-term plan. You know, in times like these, it's easy to talk oneself out of being disciplined, saying, wow, the markets sure are hot and the economy's going good. I'll wait to take some off the table after this run. Or, wow, the markets sure are bad and the news is going to get worse. I'm not going to buy yet. I'll wait until things settle down. At MCF, most of you know our investment philosophy because we've preached it at almost every meeting and conversation. You can see that there's 4 disciplined approaches that we have. First is defining your portfolio cash flows. 2, diversification across multiple asset classes. 3, maintaining your focus on your plan. And number 4, we must understand future capital market expectations for both risk and return. Diversification within multiple asset classes is the only free investment strategy available. The act of a disciplined portfolio rebalancing strategy is the art that produces successful outcomes for investors. Whether you're an individual, a pension fund, or an endowment, it's all the same. Let's take a look at the last 50 years asset class returns by decades. You see here the 70s, 80s, 90s, up to 2000s. The 70s, we remember high inflation, gold, commodities, stocks, and bonds were negative returns for a decade. The 80s were reversed. International and U.S. stocks and bonds did well, commodities and gold on the bottom. The 90s, somewhat the same. The 2000s flipped again. Real estate, commodities, gold, stocks were on the bottom, both international and U.S. And the last 10 years, you know, we've had a big run. Well, what will 2020s look like? We'll see. When you allow us to focus on your plan, you will have a greater sense of calm. Not because we or you believe life will magically become stable or predictable. If anything, the forces of change are accelerating at an increasingly rate. You feel calm because we've increased your understanding of what it takes to survive, navigate, and prosper. Our job is to have you better prepared for what we cannot possibly predict. You must invest for the long term. But investment survival has to be achieved in the short run as well, not just on average over the long run. And let me illustrate. We should never forget the story about a 6-foot man who drowned crossing the river that was on average 4 foot deep. The man obviously didn't understand averages, for the middle of the river was 15 feet deep. Lesson learned, averages can kill you. Investors must make it through the low points to survive and prosper. As a captain of your ship, we intend to navigate you successfully to your destination. For we never know when the storms may come, or how bad they'll be, or how long they'll last. However, we do know how to weather the storm. This is not our first voyage, and we remain committed to steering this ship to your destination. Be steadfast, and thanks for tuning in for the MCF Perspective Moment. See you soon.